5:27 hora central europea, vamos a hablar de estrategias de inversión y lo vamos a hacer con Teresa Keane, Product Director at Alliance Bernstein. Hello.
Hello, good afternoon.
How are equities performing and what is on investors' mind?
Well, good afternoon, everyone. Yes, equities, at the end of last year, equities were up, strong double-digit returns. Global equities, as measured by the MSCI World, were up 19%. US equities as a whole, as you know, were up stronger, up 25%. And really what we saw throughout the full year was really growth, providing that really strong performance overall. In terms of fourth quarter, it seems like a long time ago since then, but performance was certainly very mixed. And indeed, over the full year, what we saw was a continuation of technology, communication services, as well as financials and consumer discretionary really performing strongly at the sector and industry level. Healthcare ended the year quite disappointing returns, as well as materials and energy. But, you know, the world as we know it today is really undergoing a lot of change. And what we're seeing is three things, really, or four things. Globalization, internationalization, of course, AI is going to change people's daily lives. And we've seen a lot of that in the news recently. And then, of course, we're seeing China go into deflation and Japan going into inflation. So some significant changes that we have not seen over the past decade. And we as investors are really fully committed to managing these risks and opportunities in order to deliver on that long-term return and those superior risk-adjusted returns overall for our clients. So in terms of our clients and what's on their minds, well, there are a few things, and certainly Trump is on the mind of our investors. Trump 1.0 versus 2.0, what's the upside versus the downside, and how are we balancing the risk and opportunity? And number two is very much AI. The question last week would certainly have been how high can they go? And of course, we've seen that volatility in the marketplace this week and earlier this week. And then number three, rising bond yields with regards to Q4, what we saw over the course of Q4, and whether that's going to derail economic growth. So really quite a number of things on investors' minds as we enter Q1 2025 for sure.
Coming into the year 2025, investors may have been asking, why bother with defensive equities? US is doing great. How different of an environment are we in?
Well, I mean, I think that's a fair question. The last time we saw, should we say, a drawdown in equities or a significant down market, it's not that long ago, actually. It's in 2022. But from October 22 all the way through to today, we have seen volatility in the market, but we've seen very much a rising market. So regardless of the market environment, we would say that it's really important that investors are diversified, not just across asset classes as a whole, but also within equities. And so within this environment, we think it's really important that in terms of the environment that we're in now, what we're seeing is that valuations are certainly higher, spreads are lower, and interest rates and inflation also are higher. The economic environment, of course, is very different as well. Unemployment is certainly lower, but what we're seeing is that rates are certainly higher and core inflation is also higher. So a very different environment from, should we say, Trump 2.0 to what it was a few years back. And then in terms of some of the short-term risks, we certainly have tariff risk as well as immigration risk. In terms of some of the medium-term opportunities, really they'll come in the form of tax cuts and regulations, but really we think it's prudent to balance these risks and opportunities that are out there in the marketplace today and be very prudent with regards to that.
Teresa, you mentioned short-term tariff risk. So how are you positioned to address such risk?
Yes, So as always, it comes back to our quality, stability and price framework, and that's our underlying philosophy and our approach. So really we're looking, as an active manager, we're looking for those companies that have consistent cash flow, measures of profitability like return on invested capital, return on assets, and we're seeking to invest in those companies that are less susceptible to those wide market swings. And then of course price will always be important. We're avoiding that crowded trade. So in terms of today's market environment in particular, we're offsetting some of that tariff and immigration risk to earnings with stability. And then we're mitigating that crowding, and particularly crowding within growth stocks, within AI, with that price discipline. Within AI, for example, we are certainly underweight semis and we're overweight software. And then with regards to rising bond yields, and inflation, we're leaning into quality. And then coming back to that tariff risk that you ask, I would say that our framework actually lends itself to being less susceptible to tariff risk as a whole. And what we've seen is that within a number of sectors and industries, because of our overweights to services and underweights to goods, for example, we have that less exposure or that less risk. After all, that's what we're seeking to do. We're seeking to deliver on upside and very much mitigate risk on that downside. So, for example, within consumer discretionary, we like names like Compass, which is that UK food service catering company. Within industrials, we very much like services companies like Relx and Wolters Kluwer as a whole. And then other names, which I've also spoken to about, is Prismium, for example, and that's a cable company, high voltage cable company connecting offshore to the grid, and they've got extensive manufacturing operations facilities within the US, so the portfolio is benefiting from that as well. Within technology, as I said, we're underweight semis and hardware, and we're overweight software. And then in terms of regional exposure, we are underweight the US and have been for some time, more based on price, more based on valuation, and we're overweight Europe. However, when we do look at revenue and we look at US dollar revenue, we're actually neutral versus the benchmark. So in a way, we're offsetting that underweight, which is good news and a benefit for the portfolio and our strategy as a whole.
Teresa, the last one. Are we still in a crowded market? And what is your outlook for the rest of the year?
Yes, we are still very much in a concentrated and crowded market, and that's really continued on from last year as well. And in particular, if we look at the Magnificent Seven, or the top seven, should I say, they are still trading at a premium. The current premium is around 64%, whereas the average is around 39% over a 10-year period. So that's significant. And then if we look over 12 months, the next coming 12 months on price to earnings basis, you can see that non-US companies in particular are still trading at a discount relative to the US. And you can see that they are at a significant discount, probably around the region of 39% today, whereas the average discount is usually around 21%. And then in terms of convergence with the rest of the market, what we're seeing is that we do expect to see that convergence. It might be a little bit slower, but it will move into, it's likely to go into the first half of 2026 as a whole. So then in terms of outlook, we do expect to see some volatility in the marketplace today. We expect to see also some slower growth. Tariff risk will be a concern, and particularly in regions in the non-US regions of the world. Inflation is coming down, and it's coming down on that downward trajectory. However, in regions like the US, it might be slower. Rates are continuing to fall, which is very good news as a whole for the economy. The US, of course, is expected to lag given the better economic outlook there. Fiscal deficits are still a concern at 6.7%, very high, so that still remains a concern. So we as active managers will continue to look for these companies Be nimble, look for these companies that are consistent in delivering that quality, stability, price framework, delivering on that upside participation during rising markets, as well as mitigating risk when the market is declining, delivering on that superior risk-adjusted return for our clients at all times.
Teresa Keane, Product Director at Alliance Bernstein, thank you for joining us.
Thank you very much. Have a good rest of the day. Thank you. Bye-bye.